A monster stock market rally after Russia declared war on Ukraine. You saw a huge 6.6% rally in the S&P 500 off of the lows on Thursday. Is the sell-off over? Is this monster rally going to continue into next week? We're going to talk about all that more in this video. First, make sure to like and subscribe to this channel so that you can get all of my stock market analysis all throughout the week, and that you can be notified each and every time I post a new video. Plus, make sure to click the join button down below to get all of my stock market research that I provide members each and every day with. The S&P 500, the NASDAQ 100, and the NASDAQ Composite, they all snapped 2-week losing streaks, and they staged massive moves off of their Thursday lows. That's got a lot of people saying, hey, the bottom's in. We bottomed back on the 24th of January. Now we're bottoming again here on the 24th of February. The Federal Reserve can't raise rates in the middle of a global crisis. How many times have we heard that one before? And here's the thing. I think the Federal Reserve should be raising their interest rates. And there's actually a possibility now that they won't. The talk of a half-point rate hike is off the table now because of the whole Russia-Ukraine crisis, which frankly doesn't make much sense. I still think you should be raising it that or more because it's the Russia-Ukraine crisis that's actually going to make oil go higher if the crisis continues to prolong itself for weeks and months. Oil going up is going to cause everything else to go up that requires transportation costs to it. And that means all of your food, your gasoline, and anything that you buy off of a shelf at a store is going up. So the only way to do that is by cutting demand for oil. And the only way you do that is by getting the money out of the system. Like I said, 50 points off the table, 25 points right now is what most people are expecting. Wouldn't it surprise me if the Fed, because they don't want to cut rates, they're only having to do it. So they're looking for any excuse that they can find to not raise rates. And so guess what? Russia declares war on Ukraine. Perfect out for the Fed to say, hey, as a result of the war, we're going to have inflation. You got to just deal with it. You're already seeing the news outlets out there saying that inflation's because of Ukraine. No, inflation's been going on for years now. The market's pumping endless supply amount of money into the market. You already have some of the banks calling for more QE. I mean, it's the biggest clown show in the history of modern banking. But as traders, what do? Do we say this is what should be and we trade according to what we think should be? Or do we look at what it is and what the charts are telling us and trade according to that? It boils down to whether or not, am I going to force my will in the market or am I going to follow the will of the market? You have to follow the will of the market. You got to follow the direction. You can't try to force what you think it should be doing. And then when it doesn't happen, you just throw your hands up in the air and say, hey, it's rigged. You can't do that unless you're just wanting to lose like endless amounts of money. You got to follow the market's direction. So Thursday and Friday in the S&P 500, NASDAQ, Russell, all of them, it was a big deal. Now, we've seen big bounces like this before, and we'll go ahead and get to the charts right now. We've seen big bounces like this, and we've seen where the S&P 500 will rally for 3 or 4 days, get a little bit choppy, and then sell right back off again. And so there's the potential for that to happen here. This bounce, very similar to the bounce that we saw in late January. But what would it take for what's been quite the bearish month in January and again in February to turn bullish? Well, the S&P 500 actually only needs to rally like another 131 points to finish green on the month. Could you imagine that? On Monday, we rally 131 points, and all of a sudden, the market finishes green. Most traders won't feel like it was a positive month, but you have a head and shoulders pattern that I highlighted in last week's update. Now, we broke below the head and shoulders pattern, and it was getting very bearish, but like what we've seen so many times, and it's almost exhausting, but we've seen it so many times going back to the 2009 Great Recession bottom. You get these head and shoulders patterns, and textbooks will tell you that once they confirm it should go straight down, right? Rarely the case. Instead, you get this like teaser candle where it sucks in a lot of short sellers. You get some follow through the next day, or you just gap up the next day and you just rock it right back above the neckline. In this case, we gapped way below and then had a historic rally off of the lows. 6.6% in 2 days. That is massive. How much technical damage has been fixed? Not a ton. Outside the fact that we're back above this massive support level, that's big, but there's still a declining trend line with higher highs and higher lows still in place. It started back in early January, and it's been a consistent source of rejection each and every time. So with us sitting at 437.70 on SPY, if you start to see a rally this week that takes us into the mid 440s, like let's say 446, 447, then you're getting a legitimate test of this declining trend line. That will be the point in conjunction with this 200 moving average to see whether or not price intends to push through there and set up a situation where we try to take out the February highs. Then if you take out the February highs, you're looking at that move back up to 470, which was some heavy resistance before, and then the all-time highs. That's the roadmap for the bulls going forward. For the bears, they're going to have to break back below Friday's lows. That's pretty much the key to the bears going forward. Break below 427.86 and close below it. You're back below this neckline here, and you've wiped out and reversed Friday's gains. It's not so much the two-day rally that makes me wonder, is the market going to rally back up to all-time highs or become more bullish going forward? It's more about the fact that the Fed is trying to change its tune. It's trying to look for an out, or at least it's being perceived that way with some of the talk that we've seen out of the Fed this past week. And so if they do get more dovish and the war tensions continue to escalate, the market may actually rally. Also, it's worth noting, if the bulls can break back above the February highs right here around 458, that would effectively nullify this massive head and shoulders pattern that's been forming since August. So at 458, this head and shoulders pattern means nothing anymore. Also, as people who follow the technical analysis on the charts, it's also worth pointing out, there's been no shift in the downtrend as of this point. We still have a series of lower lows and lower highs in place. This is where the all-time highs were formed. Then we put in a lower low, lower high, another lower low, then another lower high. We put in a lower low this week. Now we're trying to establish what should be the next lower high if this declining trend line holds up. So there's two outlooks on this market. One, the Fed's not going to tighten and the market's going to respond favorably to that. The Russian-Ukrainian war will be an excuse for the Fed to actually become more dovish instead of holding on to that hawkish outlook that they've had for most of this year. When that's the case, these kinds of candles, these two-day rallies makes risk reward very difficult. If you're to simply buy right here, put a stop loss below the recent lows, you're talking about a 270 point move. That means just to get a 2-to-1 return, you need about 540 points to the upside, which would take us beyond all-time highs. To the downside, the path is much easier if the Fed stays on track and wants to continue raising the rates and not put any more QE into the economy. And doing so needs to break this candle from Friday. Second, you need to know that when you're in a bear market, you're going to have massive bounces. The bounces are massive, so you have to be aggressive on the profit taking. I was short most of this week, and what helped me out the most was the fact that I was taking profits along the way. I was in QID and I was in RWM. I was 2/3 long on my RWM position still on Thursday when the market opened. I immediately took 1/3 off the table. When the market started bouncing, I got out of the rest. Same with QID. And they turned out to be really good trades. But while at the moment, I wasn't sure if this market was going to collapse and by selling, I would be giving up a lot of big gains. I also knew too that when you're in a bear market, the bounces are extreme and they can wipe out a good profit on a trade in a second. And that's what you got on Thursday and Friday. So you have to be protective of those profits. The reward to risk is much more favorable now still to the downside following the Thursday, Friday bounce. Thursday, Friday bounce makes it to where the reward risk to the upside is still kind of difficult. What you really need with the indices is to consolidate some here instead of just continuing to streak higher. Consolidate some and create better reward risk ratios on the charts for you to trade off of. And that's what I'm really hoping to see. If we're going to go back up to the all-time highs or continue to push higher in the near term, let's get a little bit of consolidation here, because trying to chase the market day after day after day with gains that it's putting on makes it very difficult to manage the risk when that rally subsides. So let me know down in the comments down below. What is your strategy for this week? Are you bullish? Are you bearish? What do you think the Fed's going to do? I want to hear all about it. And make sure to click the join button to subscribe to my YouTube membership. And thank you and God bless.